Drew, Meredith from Wattle Partners, welcome back to a reporting season roundup, mate.
Thanks, mate. Long 12 months, I think, for everyone.
Yeah, it's been a long time between drinks, right? Like last year, we were doing this every week during reporting season, and this time we just missed it. We were just so busy. So it's good to just do one roundup. We're going to bring kind of our two best and worst. I think worst is a bit harsh for some of the companies that I'm talking about. They just didn't meet expectations, we'll say. So I'm going to be focusing on small caps. I've got one large cap US tech stock in here. You've got mid and large cap Aussie, which is good for a variety. So yeah, like I said, last year we were doing these weekly. We just thought we'd jump on the mic and talk about what we like doing. For those who don't know, Drew's been on the podcast before, the Australian Investors Podcast. He's spoken to me many times on our YouTube channel, and you're a financial advisor at Wattle Partners. How's all that going, mate?
Probably the busiest we've ever been. So it's great. Had a strong 2020. Got some ideas and asset allocation calls right during the year. So yeah, not much break for us.
Yeah. And then is that when you say busy, do you just mean more clients coming on board as well, or?
Yeah, so we've had quite a bit of interest in new clients coming on in the last quarter of 2020, and growing team. I think 2 new staff on as well. So
yeah, cool. That's great, mate. It's always good to hear because seeing the office, it just seems to be expanding every day, and I just don't know who's. Wait, what are you doing? And it just seems so many people walking around, and it's just. I mean, credit to you for putting in a good performance for your clients last year. Before we get into the companies, obviously this is anything that Drew and I say in this podcast is limited to general financial advice only. So you should seek the advice of a licensed and trusted financial professional before you act on any of the information, because we haven't taken into account your needs, goals, or objectives. Also worth noting is that Drew or I may own shares in some of these companies. We may have formal recommendations for or against. So again, don't act solely on the information you hear or watch. If you're watching this on YouTube today, you can find more information by going to the T's and C's and financial services guides on our respective websites. So Drew, let's start off on a negative note. It's a video about the best and worst, sometimes the worst of the juicy ones. So why don't you give us one straight off the top? What was one of your disappointing results from reporting season?
It wasn't necessarily the report that was disappointing, but obviously the share price reaction for me was SEK Limited. So, one of the rare, really good Australian growth companies, does job ads. It was a stock we bought for most clients back in April last year at all-time, or not all-time lows, but something like $14 or $15. Somehow it went from there to an all-time high within about 6 months, despite it being a very difficult job market. So I think it was always going to disappoint a bit when they reported. But probably the most interesting part about it was they sold their a major part of their share in Xiaoping, I think is the best way to pronounce it, which is the Chinese job ads company. Become a significant part of their overall business in Australia. Some analysts are saying it was sold at a potentially lower multiple than what the company itself was trading at, which is a kind of a weird situation. And the share price has fallen off by about, I think, 20% after that. At the same time, CEO Andrew Bassett stepped down to move over to the investments division. So SEEK has its core job ads and education businesses, and then it also makes venture capital investments, which is where Xiaoping actually came from. So he's moving over to run that venture capital business. And I think I was talking to someone else recently, it's quite common to have these, investment companies within other companies in Asia and in the US, Warren Buffett, all these kind of groups. But in Australia, I think almost dividend focus has meant that people don't necessarily see the value as much. If they want to do venture capital, they probably try and buy a venture capital fund rather than invest through SEEK. So I think that's part of the reason it fell off so much. But generally, profit only fell 8%, and revenue was only down 7% on the previous year for the half. So not a bad report, just more the reaction and major events happening there.
Yeah, because I know you guys liked this for a while, but did you sell shares not too long ago?
Yeah, we sold it, I think it was almost a 80% gain. So around $26 or $27, I think we recommended selling it on the basis that That was around the time that a short sellers report came out about some potential issues in their Chinese business.
Was that around, sorry, Drew, was that around, just fake job ads effectively? Was that what it was?
Yeah, exactly. Yeah.
I remember reading something. I just can't find it right now. So I was a bit, okay.
So
Yeah, right.
That's right. Yeah, we think it's always been a good business, compounding growth. But when you see a major change like this, it kind of resets expectations, I think.
And I think, am I mistaken? I could be completely off the mark. Probably should have researched this before I came on, Drew. But the Bassett family, I think they do have investments in venture capital, or they have experience in that market anyway, right?
Yeah, I think his brother runs SquarePeg, so it's probably the
Yeah.
most well-known venture capital group in Australia. But that's a yes, completely separate venture capital business.
Yeah.
And I think with Seek, their focus is on backing similar advertising and education-based plays, whereas SquarePeg would be much broader.
Yeah.
So that's Andrew is at Seek and Paul is it?
Yeah, I think that
SquarePeg,
maybe.
I think.
Yeah, we probably got that wrong. Someone will correct us, but yeah,
probably them.
Yeah. So that's really interesting. Okay, so this is a business that's been a success for so long. So it's interesting business. It's not one that I own. Just happy to watch this one from the sidelines. So for me, I'm going to start off with the smallest company on our list today, which is Envirosuite, ASX ticker code EVS. Do you know Envirosuite?
Not well.
Yeah. All right. So, it's a small cap company. Not many people know it too well, but basically Envirosuite, as the name might suggest, it does technology software primarily for organizations and groups like asset owners that need to consider the environment. So things like water pollution, noise pollution, air pollution, all those different types of things. It's kind of that triple.
Like your Green Warrior investment. Is that what we're back to?
That's what we're back to, mate. Yeah, that famous phrase, Green Warrior. So it basically, it's in this kind of sweet spot of software that's looking after the environment, right? And companies now need what we call a social license to print money effectively. So, if you have an energy facility, like some sort of industrial facility that needs to monitor our air pollution or noise pollution, you would get some sensors put on, and Envirosuite could help you manage that. So they would come in and consult. They would put in the devices. They wouldn't make them necessarily themselves, or if they do, they would kind of outsource that anyhow. But their software effectively provides the platform for you to integrate all those different sensors and to consider them in one kind of dashboard. The results, for context on Envirosuite, they actually made a kind of like a reverse takeover. They acquired a business that was much larger than their own. And that business brought with it many, many employees from right across the world. And so they had to kind of do this complicated restructure. And for investors looking at the numbers, what makes this particularly difficult is that, I'll give you an example, right? So what we had to adjust revenue, and it was up 17%, but we don't know how, it's very hard to know. $23 million of adjusted revenue, up 17%, but the comparable period includes 4 months of revenue from EMS. And it's very difficult to know how much of that was coming from EMS, simply because the deals that it strikes are they're not as transparent as kind of like a pure play SaaS business. So it was pretty hard to decipher, what's organic revenue, what was required, how much of that organic revenue is new revenue. What's
interesting? The problem getting a read on these lower, these kind of acquiring roll up almost businesses and in fragmented industries.
That's it. Yeah. And that's the thing, right? Like we kind of have to take management's word for it a bit. And one of the things that came about during it came about as the results were being dropped, was that the CEO is stepping back. He'd been with the company for 2 different stints. I think it was a period of 8 years. And the COO is taking over, Jason Cooper, who started in July last year. And one of the interesting things is that if this is a business with staff in many different countries, doing many different things, is that if you started as Chief Operating Officer in July last year, chances are you haven't met many of the employees that have been part of this, because you haven't been able to travel. It's not an easy thing for even a COO or a new CEO to kind of get in and get a handle on quickly. So that kind of spooked the market. And one of the things that spooked me, Drew, and I'm not sure if you've seen this before, but the CEO salary has a base salary, but then a effectively all of the long-term incentives are based purely on share price.
Yeah.
And I don't need to explain to you, but for those people who are listening along at home, what that effectively means is that it can encourage behavior which is, aimed purely at getting the share price up. So you could go out
short term.
Yeah, you could go out and acquire revenue. You could make acquisitions. So you build your empire, if you like. As Charlie Munger says, show me where I'm going to die and I won't go there. This is incentive structures in small cap land are very unusual at the best of times. So
I call it the Wild West. So
there you go. Yeah, and that can be when it's like, right? So the problem that we have with this kind of latest, I guess, not change in tack, because it's not a change in tack, but just the business in general, is that it has a long history of issuing shares. So I was looking recently, and in the last few years, we've seen the weighted average number of shares outstanding rise to over 600 million. For context, in 2015, there was just over 100. And so, it's just kind of in this steady upwards trajectory, and it's like that dilution that you just don't see every day. It kind of just eats away at your returns over time. So, I mean, it was a pretty hard to see result. Management said that a fair bit of the revenue, 85%, is recurring, and less than 0.5% of revenue comes from China and is mostly non-recurring. And that's important because there were a few issues with that during the period. If I'm being more positive, costs of revenue kind of flatline, so we're starting to see more margin.
Yeah. So they're extracting something from the acquisition. It's not just bumping up revenue.
No, that's it. They took some costs out from redundancies. There were some one-off costs in there for acquisitions. And so margins are going to go higher, I believe, but it's just a business that is quite hard to get a handle on. And I think that's what's holding institutional money, on the sidelines as well. I think we really need to see that execution with wider margins and free cash flow, which it still hasn't achieved yet. So that's Envirosuite, ASX ticker code EVS. We have it as a recommendation. It's a speculative company, so keep that in mind. One to watch for sure.
I think it's an interesting comment around cost cutting is redundancies. It was kind of, probably the theme of reporting season was cost cutting, and we kept our costs low. But you've got to look closely at what it is. Are they cutting staff that they then will need to re-employ at some stage? Are they running down inventory, and then they, have to eventually pick inventory back up, because there's different ways to keep your costs low. That was some of the things I was looking at.
Yeah, it is, and that's a fair point, right? Like I think that these redundancies would have happened even if COVID wasn't a factor, because bringing these two businesses together, there were certain synergies that could be had. So perhaps this was it, but it's just being mindful going forward. The business, in my opinion, needs clear vision and strategy, and it needs to articulate that to the market before it's going to attract that institutional money. So interesting business, one for the watch list for a lot of people. So that's my number one. How about your number two? We'll go with the worst before we get to the best, Drew.
It's not one we've held or probably would ever hold, which is A2 Milk. Had a shocker. It was you could kind of see it coming. I think it was their second downgrade in a row, not their third. They say downgrades come in threes. A2 Milk makes special milk. They say it feels better. It only has the A2 protein. I've tried to understand it, but gave up after a while. And a massive part, something like 48% of their sales go into China in various ways. Some of it's through normal shipping, and some of it through this Daigou channel, which is more fragmented, I guess. So clearly, with travel restricted, people buying and taking and selling infant formula and these sort of things in China was impacted. Profit fell 35%. Sales were down 16%, and the companies, I think, trying to readjust their approach to the Chinese market. I kind of see it as this, similar to Treasury Wine. I understand as a business owner, they see an opportunity in China and it quickly becomes massive and the biggest part of their business. But it just shows you again, 48% of your income coming from one country. It's obviously very dangerous proposition. You need a significant diversification, I think. Is there one you follow, or?
It's really interesting because I I've owned Bubs shares in the past. It was probably it's an investment that for our Rask Invest service, it's the one that I regret the most because I totally I guess the quality just wasn't there. I underappreciated the risks associated with China as well.
Yeah.
Doing business in China, we had an update called Doing Dairy in China, and we profiled the major milk companies, including A2. And I'm just looking at it now. You can't see it on my screen, but one of our analysts looked at it, and it had this kind of flow chart with all of the state-backed or related enterprises that kind of go into this web. And then you just see this purple circle where A2 Milk sits. And it kind of sits in between manufacturers, with Synlait Milk, Fonterra, and then it's got, relationships with this China State Farm Holdings in Shanghai, and then that's 100% owned by this China National Agriculture Development Group, which is 100% owned by the State-Owned Asset Supervision and Administration Commission. And it's just this whole web just goes around and around, right?
Yeah, so it's like a middleman not a middleman, but they're pulling in from dairy owners and then branding and shipping off somewhere else.
And the scary, I think the precarious thing is that I underestimated how complex that web was and what effectively had to go right for them to just provide, sales straight into China. And then you add in COVID where that Daigou channel isn't as, efficient.
Yeah.
And it's like you said, the writing was on the wall. Well, one of the things that this is kind of giving me pause for thought is also the Matura Valley. That's an interesting deal if you trace back kind of who that's owned by. And then if you look at like what A2 Milk was in the past, is that it was great because it was a capital light business. Like you said, it just kind of slaps the A2 Milk
label on
label on it, and then it ships
branding.
it off. Yeah. And then I end up paying double for it in the supermarket as well. I've got to be honest, I've got some in the fridge. And it's a great business model, but then if you think of the external influences on that business, I think it's a higher risk than what many people were appreciating. There will come a time to buy it if you're so inclined, but it's just going with your eyes wide open. So Drew, have you ever owned A2 Milk?
No, I haven't. It kind of, for me, and Treasury Wine last year, that had a similar issue with Chinese government. This wasn't a government issue, but kind of reiterates, it's so easy to invest directly into China or America now. So it kind of relying on companies as a proxy, like Australian companies for a proxy, I don't think we need to do that anymore. That said, it has its own merits at some stage. Ultimately, it's a commodity company that has great branding.
Yep.
That brand would be an Australian success story. Maybe it's New Zealand. We've stolen that.
We'll claim it if it's doing well, but
but it's great branding, but a commodity company.
Yeah. And that's, it's a interesting one because you have to understand the competitive position and the competitive advantage of any business. And then you also need to know your limitations as an analyst. I think, you need to know what you can and can't know, and how much of those things that you can't know, you're willing to go along with. And that's where you get your uncertainty and you make your risk ratings for evaluation. And for us, we struggled to get a valuation. This was before the result. Struggled to get a valuation above $10 if you're being more conservative, as we were. So it's $8.88 now. I'm just looking at it on Google. So maybe there's a time and a price for it. Who knows? Maybe it's one for the watch list. So that's a good one. So my number 2, and this is going to come as a bit of a shock to people. It's not worst is, I only really tend to follow companies that we have kind of in our purview for our membership services. I don't really tend to go beyond that. And so my focus is quite narrow, but tends to be deeper. That's how I describe it.
I look at everything the ASX 50.
Yeah, see, I don't have to.
That's why I'm so tired.
That's what keeps you busy. That's why you keep writing those daily reports. You just cover everything. For those of you who don't know, Drew writes this quarterly report, which I would think is like 40 pages long. Would that be fair?
The content's probably about 10.
Okay, right. Okay, yeah, it is just so. I don't know how you do it, mate. I couldn't do it. Anyway, my number 2, and it's a company, and the reason why I bring this company up is because I've talked about it on our investors podcast before, and it's a recommendation inside our Rask Invest service, and it's RPMGlobal, ASX ticker code RUL. It's a mining services company, does software for mine development and for asset maintenance. So imagine you have the big trucks that look like the old Tonka trucks you probably played with as a kid. They're driving around the mine site. As those trucks get more sophisticated in terms of, their, machine learning, their ability to self-drive, speak to other assets at the mine site, RPMGlobal's software effectively provides the backbone and the tools to connect all of those systems, those disparate systems together, and it integrates with the likes of SAP. So it kind of creates this all-in-one software suite and dashboard for its users who are mining clients, etc.
Toddler would love it. He's obsessed with diggers and
just
tractors, and
tell him all about RPM, and I'm sure you'll get even more excited. So during the recent half year, reported revenue down 20% to 32.5 million. The thing about RPM, and I've articulated this before, is that it's transitioning from pure consultancy to software. And that transition is still underway under CEO Richard Matthews. So subscription revenue for software jumped 65%, but it's small. It's a smaller amount, 6.4 million. Total contract value sold during the half was 14.5 million. From our calculations, that was down from 21.5 last period, comparative period. But as always with these subscriptions businesses, is it's interesting to note how much of the revenue is incurred in a certain period when it is sold. So RPM sold 14.5 million, but it only generated revenue of 0.8 million from those contracts. So it's just banking that revenue, and that pushes up the total contracted value of those subscriptions going forward. If I just jump ahead, the business turned a profit, but it relied on some JobKeeper subsidies, and the business struggled to do maintenance on its software and to get the consultants out to mine sites. And a lot of the mining companies were a bit reluctant. The knee-jerk reaction for most miners, I would imagine, is let's just pull back on new spending until we know what we can and can't do with COVID. And if I just jump to the bottom, RPM still has a really strong balance sheet. It's got $32.8 million of cash and no debt. The business now has lower costs as a result of COVID. It's still growing quickly. And from the first 7 weeks of the third quarter, it looked like it was off to a very strong start. So I'm still very positive on the company for the long term. It was just a hiccup, and it reminded me how cyclical that advisory side of the business is, coupled with that COVID impact.
So it's like a capital light mining services company.
That's exactly. And it's transitioning more towards the software and away from the consulting side.
Like Worley Parsons and Orica had shockers because everyone was stopping, as you said, their CapEx.
Yeah.
But that's, they have much bigger teams. They operate and build projects. They need a lot more capital. So
that's it.
It's not unlike the rest of what's happening in the industry, it sounds like. So
that's it. Yeah. And over time, I believe RPM is going to become more valuable for every incremental dollar of revenue it brings in. So, in 3 or 4 years, the multiple that we apply to a business is effectively in the OpEx budget, not in the CapEx budget. This business is going to be more annuity-like. It's going to be valued accordingly. So there's kind of that two-pronged, thesis here, which is that the business is getting better, but investors would be willing to pay more for it in time too. One thing that's really interesting about RPM, which it goes against some of the other mining services companies, Drew, is that it has continued to invest significantly in R&D. When Richard Matthews took over in, I think it was 2012, 2013, he just invested heavily in tech. His background is ERP systems. And that effectively put them where they are today. That 6 or 7 year spending cycle, consistently spending on really good engineers, really good developers, and just growing that subscriptions from the software. And it's good to see them still doing that today. Even through COVID, they're spending and just building a better product for their customers. So I really like the business. It was just a hiccup in the road.
Yep.
So let's get more positive, Drew.
Positive. So I'm super positive. I'm going to give you a bit of a, what do you call it? Who's this company? So
Okay.
They've a bit of a game to make it a bit more fun. So if I told you there was a company that had double-digit sales increases, was involved in e-commerce and batteries and the battery supply chain, and they increased their dividend by 17%, what would you say?
I'd say it's Buzzword Limited.
Is that like the perfect company?
No, I think I know the answer to this one because I think you mentioned it. So, but I guess listeners are playing along at home. Double-digit growth, e-commerce, batteries, revenue growing, dividend up.
It's like the perfect storm.
Yeah, what is this mysterious company?
This unicorn.
Yeah.
So it's, as we know, I focus on the large cap. So it's Wesfarmers. Held Coles for quite a few years, sold Coles last year, but it's just had it, powered on through 2020. Reported sales growth of 16.5% to something like 17 billion for the second half of 2020. And for everyone that doesn't know, they own the Bunnings franchise, which is about 60% of their profit. Officeworks, Kmart. They bought Catch Group, so Catch the Day, all these cheap deals that you can get, 100% online sales. And they've also expanded into buying, I think it's the Mount Holland lithium mine in WA. So they've kind of made this decision to pivot. They've always been seen as a conglomerate. They just became a Bunnings-dominated conglomerate after selling off Coles last year. We've held them at different times. We hold them at the moment within client portfolios, or we've recommended them. It's just a company that seems to have great management in terms of making good investment decisions. They don't always look great initially, but Catch Group's the perfect example. I think they paid 200 million for it, and it's potentially worth 3 or 4 times that already.
Yeah, it's a fascinating business, isn't it? It's pretty much that old school conglomerate. It's much, people probably have it now in the similar bucket to Soul Patts, but this is, I guess, it's everywhere around us in retail, markets. They dominate. The industrials business has probably been long misunderstood by investors too, right? Like people kind of forget that because it has Bunnings, because it has Officeworks, they kind of forget about what it's doing in mining, what it's doing in industrial, safety, etc.
Yeah, I mean, it's a WA business, so I think every WA business has to have some mining mining assets. So I think they were renting. I don't know. I don't pay that much attention to that part either, but it's like some mining services and some chemical. I think some chemical production.
Yep.
But what I was most impressed by was the fact that last year I was probably concerned. I think we actually bought it last year. I was getting concerned that Bunnings Officeworks were getting too big. Their sales growth was going to slow down. Bunnings was getting lazy. And then COVID kind of forced them. If you've ever tried to buy something online at Bunnings, they just didn't let it. Yep. But in COVID, they were forced to go online. And for a company that's well managed and organized, probably JB Hi-Fi is similar. If you're actually selling more of your products online and you've got these massive car parks where you can easily do click and collect, well, your margins can actually expand. So you can make more profit from same level of revenue, and pretty much every business they had saw margins expand in the second half of 2020, which, given I think their online sales were only 1.4 billion in total, so less than 10% of total sales. There's still massive opportunity for the company there.
Yeah, it's fascinating. I was pretty skeptical of that Catch Group thing. To be honest, I'm not the type of person that goes on those sites anyhow, but I was a bit skeptical. But I can't remember, was it Richard Goyder? Was his name? Yeah, previously he said about 5 years ago that the biggest threat Wesfarmers faces is online, and in particular Amazon. So it's good to see them executing and just actually delivering that online experience. I've got to say, when I was going through Officeworks, through Bunnings during COVID, it was the hardest thing in the world to just process my order. I wanted like 30 things, keep in mind, but the thing kept crashing and whatever. But by the end of COVID here in Victoria, the experience was so much more seamless. It was online checkout, bang, it's there, next day you've got it.
You pop your boot, they put in the car for you.
Yep.
It was,
Yeah. And so that's, fascinating that a big company can still have that focus on innovation, invest. And I think that's the strategic advantage of these types of businesses that have huge pools of capital. They've got a cash generating business in Bunnings, and they can just afford to invest appropriately outside of that and pay a dividend. So interesting.
They've got about 10 billion in borrowing capacity at the moment. So
right.
Potential for more acquisitions.
I've heard rumors of them approaching some other listed companies. But I guess we'll just have to wait and see what happens there.
Apparently Virgin was one, but luckily they didn't do that.
Yeah, that's what's the Richard Branson quote. If you want to become a millionaire, start as a billionaire and buy an airline.
Yeah.
So my company that I'll mention quickly is EML Payments. It's the company I bought shares in most recently. So it's ASX EML. It's basically a fintech to fintechs is how people describe it when they don't know exactly what it does. So it has multiple arms to its business, but you can think about it as an enabler for payments with many of these fintech businesses. If you think of some, neobanks, you might imagine that EML might be behind the scenes powering some of that integration and some of that payment gateway, if you like.
It's like gift cards and then banking as a service.
That's effectively it, yeah. And so then we have the gifts and incentive side of the business. And a big part of EML's business depends on malls in the USA. Malls being the place where COVID seems to hang around and people don't want to go. So there was a lot of negative sentiment baked into what the market had expected. And when they reported in February, they came out and said, Christmas was actually pretty good for us. So we have a lot of gift cards. Yes, we're exposed to malls, but it was actually a really good period for us because 40% of the gross deposit volume that goes onto those gift cards actually occurs in the Christmas period. So people were like, well, we're just going to wait and see. And that's the approach that we took. We had this recommendation, but we said, we don't expect much in the short term. But then it came out and said, we've actually done pretty well. Organic growth was 25%. So for general purpose reloadable, which is a different part of its business, it's got the PFS acquisition, which is a huge acquisition. The one thing that people didn't, and I'm in this camp, didn't like about EML was they announced this PFS acquisition out of Ireland, which is this payment processing platform. And they paid a big multiple for it. And then COVID hit, and then everyone thought there was going to be a cash squeeze on EML. And then EML went back to them and negotiated terms and got a better deal and pushed the deal through. So it actually worked out in EML's favor. And one of the things, Drew, I don't know if you've ever had a gift card.
That's all I got for Christmas.
Oh, yeah. Have you ever had a gift card where you haven't spent the full amount?
Nah.
Okay, so you make the most of it.
More.
Yeah. Well, with EML, they actually benefit when people don't spend the gift card. So they have this breakage revenue. And one of the kind of natural hedges for them was that during Christmas, people weren't going to malls to buy gift cards, or so we thought, but they also weren't able to spend them. So they were expiring, and EML would benefit from this, what they call breakage revenue. And so that was an interesting business. It also has a lot of cash on its balance sheet because it has customer deposits. So it could actually be an indirect beneficiary from rising interest rates if that ever happens. Innovative business, good short-term results. I like it.
Good one.
You're lucky last. So
my lucky last. I'll keep short on this results. One. We said we're going to do 4 minutes each, didn't we?
Yeah. 14 minutes
an hour
each,
later.
Yeah.
So the big one for me is sticking with large caps. It probably wasn't the profit that was so good. It was the announcement after the profit, which was Macquarie Group. Another one similar to Wesfarmers that we wanted to own forever, but we recommended last year. At something like 70 or 80 bucks. It's up to 150 or something now. Massive high quality company. They do banking, they do asset management, like infrastructure, and they do capital markets, as in every other capital raising you've seen. Macquarie is helping do that and taking a fee on the way through. And that probably most importantly, they do a lot of hedging. So if you're an energy company that is worried about the future movement of energy prices or oil prices, Macquarie will enter contracts or prepare contracts that help you hedge that risk, so you know what price you're going to receive. We saw some gold miners, lost money because they hedged when the gold price went up, and I'm sure a lot of oil companies would have liked to have hedged the other way. Nothing stunning. Basically, they said profit will be the same as last year, but then post that, I was talking to an analyst last week who said that they upgraded their profit 2 weeks later by 5 to 10% on 2020 levels. So that's good growth. It's almost double-digit growth, almost primarily because of their energy assets in the US, energy contracts in the US that helped profit when the Texas freeze kind of swept through. So they didn't necessarily profit from people being unable to have heating. But as someone explained it to me, they had options over the passing of gas through pipelines in different parts of America that then had to be redirected towards Texas. And the demand for those pipelines obviously significantly increased, and they made significant gains on the options they held over those my understanding, or
Mm.
someone explained it to me. So
Interesting. Drew, how do you analyze as an investor? How do you, like, are there certain key metrics you look for with a bank like Macquarie Group? I've often struggled because it's kind of most investment bank, part retail bank. And I kind of have this lens for retail banks, but not so much one that fits for investment banks.
They started to help with that, to be honest. So they split it into annuity-like businesses and then into market facing. So obviously that energy business is market facing. Annuity-like is their asset management. So if you think about a Macquarie, Winton's Global Alpha Fund is issued by Macquarie, I think. They get paid a fee for offering that investment in Australia. So that's pretty consistent. It's based on the amount of assets that are in the fund, and they've got 550 billion under management in that part of their business. So banking and asset management, pretty consistent. You can put a pretty simple multiple on that, as you're saying. Combine an asset management multiple and a traditional bank multiple. But then capital markets, I don't think you can really predict what those are going to do. So you have to have maybe a fairly conservative view on whether they'll grow. Macquarie Capital did something like 100 transactions last year in the billions and billions. They floated Nuix, so they own part of Nuix, which you probably covered too. They're very, things like performance fees, like a Magellan or a Platinum, are part of the asset management division. So those parts are less predictable, but the core bit you can get a better idea on. I think that's why it fell so far as well last year.
Yeah, I was just looking quickly. From February last year, went from $150 to March, $80.
$80,
yeah. So I mean, if that's your opportunity, you might be able to get in with that more conservative valuation, which doesn't bank in much from the capital markets part of the business.
Exactly.
Yeah, cool. That's a good one. Okay, so last one for me is a US company. I'm going to go large cap from one end of the spectrum to the other, which is Pinterest. I've talked about this on AusBiz recently. Pinterest, for those of you who don't know, is a place where you can go, a social media platform where you can go and you can actually feel good about yourself. So there's something to note about it. It actually is. Its studies have shown that, when you go to some of the portals like Instagram or etc., you actually leave feeling worse than you went there. Pinterest is the opposite of that. So you can go there and you can get inspiration, and people see it as a source of happiness. So 91% of people say that it's a source of happiness for them. And I don't know, have you ever used Pinterest?
For my wedding. So getting ideas when we got married for like design and all that sort of thing.
What a great time in your life, right? So happiness.
It was my anniversary on Sunday. So
congratulations,
timely.
Mate. Yeah. And you can thank Pinterest for that making that a success. Yes,
exactly.
So that's the investment thesis. No, I joke, mate. Congratulations. And Pinterest is a place where people go for wedding inspiration, primarily for food inspiration, and the one that I use it for, which is renovation inspiration. So around the house, home decor, kitchen benches, etc. If you want, we want to put in a new servery in our kitchen that goes onto the decking. So you get ideas from Pinterest, which you can then use, as a kind of base for your plans or whatever. And so just looking at the numbers that Pinterest reported, I think this was the beginning of Feb, global revenue. So they break the business out in two sides. There's international and then there's US, primarily, North America. And they make money from advertising. So they've just spent $1 billion getting a new advertising engine for advertisers to go in the back end. And basically global revenue up 76% in the fourth quarter compared to the year ago quarter. But of that $706 million of revenue, Drew, 582, or about 67%, so 2/3, came from the US, and 123 million came from international. Now, the thing about this is average revenue per user, even though they were rapidly adding users during COVID, average revenue per user jumped 29% to $1.57. US ARPU was around $5.94. So remember that $5.94, it was up 49%. So big increase in
That's great.
The average revenue per user. But international ARPU, so people like us here in Australia, the revenue that Pinterest earns from those, from an average user outside the States, is 35 cents. Now, so people look at this and they say, well, yeah, but maybe those are in like developing countries and they're not as valuable, et cetera, et cetera. But that number was actually up 67% during the quarter. And I think that's what really caught investors by surprise, is just they're starting to see that global expansion pay off. Pinterest is investing in new teams in Europe and APAC. So we're starting to see the benefit of more big advertisers come into the platform with a better platform to use, thanks to that investment in R&D. Our thesis is basically the ARPU from international markets needs to get closer to like comparables like Facebook or
which will happen
Twitter.
when you get a sales team on the ground, doesn't it? That's probably it's not because people aren't using it; it's because they don't have the sales team yet. They focus on the US.
That's it. And there's effectively two sides of this, right? Like you would go to Pinterest and you would probably look at it. This is the really interesting thing is people have purchasing intent when they go to Pinterest. So you would go there and you'd look, oh, look at that new desk. But then like one of our designers, for example, says this all the time. She's a prolific user of the platform. She says, you go on, you want to buy that desk that you see on Pinterest, but then you realize that was uploaded by someone in Romania 4 years ago and they don't sell that table. So you're like, well, now what? So Pinterest has often missed a big part of that pie. Even though people have intent, they haven't been executing. And I think now they're starting to execute. And I think we'll start to see operating leverage kick in, and it was a good result. So happy days. I'm a happy holder of Pinterest shares.
Excellent.
Yep. So that's our four. I was about to say 4 each. That's eight companies altogether. I don't know how long we've recorded for. It's been quite a while. I hope you've made
less than an hour.
Just less than an hour. See, perfect. Drew, I'm hoping we can do this again sometime soon. Hoping to have Jamie on the podcast too. So your partner at Wattle Partners. If people want to get in contact with you, how can they do that?
Just straight on the email, drew@wattlepartners.com.au. I'm sure it'll be in the notes. And mobile phone. My phone rings hot.
I won't put that in the show notes because you definitely will get a fair amount of spam coming your way. Or maybe I should. But
it's all good discussions.
Yeah.
Sign up to our daily newsletter.
Yes.
So we run through yours.
Yep. So you can do that. I'll put links in the show notes. So Drew Meredith from Wattle Partners, get in touch with him. A financial planner based out of Melbourne, but serves people all over the country. So that's pretty cool. Drew, mate, as always, thanks for taking the time out to catch up with me.
Thank you, Owen. Good to see you again.